Hello, my friends. So, I wonder if the audio is too high of that music or if it's at an okay level. Let me know. It's nice to have you all here. It's great to see you. As you can see, I have the GME Gamestop. It's in the game chart up behind me at the minute. And in the Discord last night, I was chatting with a new friend of mine who has invested in GameStop, and I said I would do a touch of the old TA on this one. So, why not? Unlike the world of crypto, which is rapidly evolving charts all the time, chart here for GME is a lot slower to move, which makes things a lot easier. And as you can see, since we did the TA the other day, things haven't really changed a massive deal. Not yet. Coming in for a bit of a cross here perhaps on the no sure thing indicator down below. Going up towards the 24-hour time frame. You can see that we had that cross over here when the prices dropped down and created that gap. We then crossed subsequently afterwards, and we've come in at this area of around about the $50 price point. In fact, the lows today have been $48.05 and the highs have been $55.24, giving us a nice range, 10% in terms of the price action today. That could of course continue. Now with this one, we're at a point where we've actually moved past the previous areas of support towards the downside. Or, sorry, they weren't really support areas. The potential for support. Let me bring up the chart full screen and I'll jump up to the 3-day time frame, fit a bit more of this in here. Gone down past this previous area, which was a high before. And now we've arrived towards this area. I'm just going to put in another horizontal line here so you can see where the prices have been managing to, where the prices are first off trying to go past next. That green serrated line is the one I've just added. Zooming on into the price action, you can see that we are below both of those. That's below both of our previous peaks. However, that was wherever the prices got exuberant. People were getting very excited towards the top here, and of course the FOMO dumb money comes in at the around the end point and of course loses out as profit taking then happens, and this captures liquidity for the larger accounts who are looking to actually offload their positions. And as you can see, the prices then drop back down the way here, and then then pop back up towards this second high, which then became this next high over here, and that's the high between April 11th and then the high again in November. And that's of course showing you that distribution from the larger accounts onto the smaller hands, smaller fish. Same thing happened over here, but by this stage the bigger accounts were just offloading the remnants of their positions onto the market, and they didn't actually decide to push it all the way back up. Or indeed, you know, if you're talking about offloading positions, it's kind of either or. I'm just using that as a phrase to get across that point. The you know, they were taking on shorts which they didn't actually have, you know, cover for, naked shorts and whatnot. That was where that was happening at. Prices dropped on down again. So it is less about the fact that we're not at the peaks which we popped past, and more to do with the fact that we're in the guts and glory section here and finding the inverse perhaps of what we saw while this was going on in terms of the prices being pushed down the way again thereafter, and again here where the prices got pushed down again thereafter, with that never quite managing to make it up quite as high as we are just now. We're in that exact same area here and looking to try and find support. Dropping back down to 24-hour time frame, you can see then over the last few days we've actually seen a degree of that happening. We had a doji candle here. Doji candles, by the way, for people, now I know those of you who trade stocks nowadays are kind of not as well informed, perhaps, as somebody who really wants to get into technical analysis. So there's certain ideas that you might not know about. And from what I've seen looking around on the internet about technical analysis for these things, there isn't any very, very, very good technical analysis. And it's not that much of a surprise. The good technical analysis, the very good technical analysis, doesn't live out there in the public domain. It actually exists in proprietary hidden arenas, such as within the confines of an investment bank, perhaps, or an asset manager, or indeed the actual savvy trader. And that information doesn't make it out into the other world. The people who write the articles that you read about on the likes of FX Street or wherever, or indeed on Wall Street Bets, they are not really well informed technical analysts, you know, and they don't really know some things. So let's try and reveal a little bit of that hidden information for you, which you might be interested in. And here we can see just an example with regards to this doji candle just here. Now, doji is the Japanese word for mistake. In English, when people talk about doji candles, they tend to use the word indecision. They would call this an indecision candle. And I don't think that that's quite as informative as the actual translation of the word doji, which means mistake. And as you can see here, we came up and filled in this tiny little gap that existed between the two previous days' price action, and then we're rejected back down the way. And it kind of indicates to you, perhaps, that there might be some mistakes on the go, or indeed indecision in the markets, depending on what sort of cultural basis you want to use for making your decisions here. And then subsequently, we've seen the prices ever so slightly move towards the top side, and the volume has been continuing to go down the way. It was going up, on average, all the way up until the point at which we see this doji candle. This is the shorting coming in here. Now, these shorts are a combination of things, or these sell orders are a combination of things, of course. The shorts, which I just was kind of referring to, and as well, the so-called weak hands. Now, it's not weak hands if you got in at around about $200 to relinquish your position anywhere on the way down here. As you can see, just looking at this chart alone, the opportunity cost of holding on to a position from around about the $200 region, especially in around this gap, was rife, and there was a great deal of opportunity cost, and especially when you consider then that you could get 4 times as many shares here where the prices are than where they were up and around about these regions. That if you had to let go if you had invested at $200 and then decided to let it go at 150, then maybe you had one share at $200. Just keep the maths nice and simple. Maybe you had one share around about $200. Then you thought, oh, I'm gonna have to take a loss here on this one of $50 and sell out for 150. Prices come down here. Now you can afford to buy 3 shares rather than having held on to that one share. Okay, so you're actually in a 3 times better position having actually taken action here on your trade. And a lot of people did that. Okay, a lot of people did that. So while the chat bumping around on the internet was be strong, diamond hands, etc., etc., the stark reality, as this demonstrated by this chart here, is that people didn't operate like that. Not really. Not the ones who like money. And instead, they actually sold and got back in again. Perhaps. Now, what we're seeing here in terms of the volume is that on average, if you look at the volume down the bottom, I have the volume candles and I have a line running over the top of the volume candles here. And this line is a moving average going back, I believe, 20 periods. Let me just double check that. Yeah, 20 periods. So at this point here, we can see that the volume starts to go down the way, and that's because if you go back 20 periods, alright, there's 20 periods for you, 20 periods. Throughout this period here, the volume was obviously increasing, and it's only then at this point here that when you go on an average over the period of the previous 20 periods, that you can see that it's less than it was on average during this period of this 20 period section. Okay, so you can see that the volume is decreasing in terms of the average, whereas in actual fact, if you were to look at this just simply in terms of the last sort of, say, 5 periods, you can see that the big drop down in volume happened over here during this period of decline in price. So we could be on the cusp of seeing the prices increase. Okay, we could be, and this is a relatively healthy position to be in. Relatively healthy compared to any period in amongst all of this price action, which was all very, very, very negative. Okay, those are some key takeaways, just initially key takeaways. Other things of extreme note and interest are the fact that the 236 Fibonacci retracement point came in here at the very edge of this gap. So when the prices did move down, the in that period over, was this a weekend as well? I think it was. In this little period here when the hedge funds and all that got together in their aftermarket trading and pushed the prices down, they pushed it to a certain degree whereby any algorithmic traders that would be operating in the market would then get on side with them, having gone past the 236 and properly broken that. So they captured the interest of each other, the hedge funds, and they forced the hands of the algorithmic traders, and they forced the hands of many savvy traders who decided that they'd probably get better value by swimming alongside the whales rather than trying to swim against the tides. Okay? Then we push past the 382, and I'll just bring that onto the screen for you so you can see how that's operating for us. And as you can see here, that's right at this point where we have the high, previously the higher of the two highs, where the distribution had previously happened. Then the prices have come down a wee bit, but they've not managed to make it towards the 50% area. If they were to make it to the 50% area, from a Dow theory, this is the theory of technical analysis which was invented in the 19th century, a long time ago. If we were to come down to this point here, that would offer up, perhaps from a Dow theory point of view, your best buy area, and that's of course at $35. Now that's kind of obvious, it's telegraphed to everybody. This price action here is anything but organic and has absolutely been forced onto the charts. Now it's not been printed on so much in the way that a low liquidity market can be absolutely manipulated and printed on by one or two players in the market, as you often see in cryptocurrencies or penny stocks, where you have the vulnerabilities and fragility in a market due to the lack of liquidity and of course due to the lack of educated and savvy traders. This is just inorganic price action which has been used to protect themselves in the face of course, huge losses, and it's a conspiratorial, it's a cartel style team effort by some people to push the prices to that point, as I said as well, co-opting the savvy trader along the way and the algorithmic traders who can see the writing on the wall and decided to get in there on that. Now we're finding a degree of support right in at this area. Let's mark it off so you can see it as we look over to the left to make a comparison as to where we've come. Let's make this red as well so you can see it a bit easier. Bum. Here we find that it was, of course, in this entire period just here. This is between the sort of 18th of January or 18th of June, right up until the 5th of November. So no short-term period at all. This is a couple of months at least, where we found it was resistance. Going back again, resistance, 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 from the 9th of April. So this is from April 2014 all the way up until the 6th of November 2015, right? A year and a half more of price action where this was resistance, and it's now operating as support. So it's not exactly entirely an arbitrary point for which the prices could find support. This is an area where there would be a degree of liquidity, and that's precisely what's happened. So what we're relying on in terms of the long case scenario for this stock is for us to find the support here at an area where for a really long period of time it had previously operated as resistance. That's just classic technical analysis for you right there. Now, we might find this continues to boil off the way. I'm less interested in no sure thing indicator, perhaps in this instance, than I am in some others. We could get a signal very, very, very soon from the likes of the stochastics over here. Now, the stochastics, when they cross, as you can see here on the stochastic indicator up on the chart right now, when they cross, they've got really two destinations in mind. There are instances, as we can see here in the past, where we get sort of confusion as to the crossing happen and then crossing back again, etc. afterwards. A few instances of that, of course there are, but in general, we go up towards the neutral line and back down again, or indeed we go up towards the neutral line, maybe consider things for a wee while as we saw the crosses happening in here, and beyond up towards the top side. And when that happens, you're looking at moving between the pre-established range, which means that if we do cross over here, there's a couple of targets towards the top side to be had. And in terms of percentage movements, they're vast at this stage compared to the lifetime of this stock. Say just not even the lifetime, but just looking back over the last decade, we're talking about far bigger potential than there has been in any of that other time. In fact, you could take months of price action at a time and combine it together, and you still wouldn't be talking about as much potential as what we've got here on this one right now. Now, does that mean that you're guaranteed anything? Absolutely not. There's no guarantees in life, but that still exists. And if we go up towards the neutral line, maybe we'll find a degree of inflection at that point, and then maybe we'll carry on. Either way, there's pretty good opportunity to be had here in terms of risk management, because you can quite simply manage your risk in it around about this red line very, 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 very simply, with a view to perhaps getting in at the next area thereafter, which is, as already been discussed, $35. If you were to take a long position from this area, call it around about the $45 mark, or indeed where we are right now, in it around about the $52 mark. No idea why that was so extended towards the downside there in terms of the risk portion of this potential measured move, or not measured move, trade setup. You know, you're looking down, you're looking for instance, if you want to be a successful trader, having a 5-to-1 risk to reward ratio is extreme. But the next area really to be looking up to after the first initial one is miles away, looking at easily a 15-to-1 risk to reward ratio on a trade here. That's crazy stuff. And that's what I meant about this being much more potential than we've had in the longest time. However, if you want to be smart / sensible at things, and remember, I'm not a financial advisor and none of this is financial advice, then the clear, easy move to be had with this one and a 5-to-1 risk to reward ratio is to be trading it in it around about this sort of idea right here. Taking this area out would be worth thinking about stopping out for. In fact, it would probably, you wouldn't even want to be in your trade at that stage. And instead you'd be looking at trying to come in here for potential for taking some of your profits off the table with a view to perhaps going on higher and capturing one of these higher profit taking targets. You know, if you were to go all the way up, you're talking about huge risk to reward potential. So that's how you would trade in around this area. And what would give you the idea if you did take that trade and prices moved a little bit in your favor that you were onto the right thing? Well, in terms of whether or not you were onto the right idea with this cross which happened on the DMI, this negative cross which happened here, you've not got that yet. So you had the cross, and ever since, the momentum in the market and the strength of the trend has hugely diminished. We haven't got an increase in the strength of trend this entire time. That's to say that really the adjustment which happened in price was an event which was perhaps ended, as indicated by the ADX continuing to slope towards the downside very, very rapidly. However, if we see another cross here between these two lines, that's the DM negative and positive there, and the green crossing towards the top side, we are in a position where the ADX is actually still sufficiently high to turn around and immediately start indicating to us that there is indeed a strength going alongside this movement as a trending potential towards the top side. We're right there. So what you'd like to see is, of course, this crossing over and the ADX moving towards the top side. We want to see a positive slope on the DM positive. We want to see a positive slope on the ADX. And we want both of these to be above the 30 line here. Ultimately, looking at this area of 40 and saying, will we make it past there or not? Coinciding almost certainly with movements up past the previous resistance area, which didn't actually act as support on our way down. More indications of positivity would come from this being confirmed as a local low. This area where we have recently come in for a low, if that were to be confirmed as a local low, then you'd have bullish divergence over here. Bullish divergence of the hidden variety, okay? That would be continuation divergence. That would suggest to people, and of course if you don't know what I'm talking about, that's fine, and you can find educational material on my channel if you want to check that out. But you'd be looking at hidden bullish divergence here, continuation divergence. That's to say the potential for strength towards the upside to come flooding back in again. How does this really work in terms of layman's language? Well, if you consider this to be strength or perhaps momentum, and we look at the depth as the strength and momentum police fly past outside my window. If we look at this as being strength and the depth at which it dropped down to, indicating to us that there was such a massive degree of that strength in there. However, we didn't manage to take out our previous inflection point there. So we didn't actually manage to make it down to the 50% Fibonacci area, indeed the Dow retracement zone. Instead, we got caught at this red horizontal line, which is where we actually saw that 18-month to much longer period. I was just saying 18 months off the top of my head, but there is a lot longer where it actually operated as support and resistance, or resistance for us. And we found support at that line. That means that the negative momentum, the bullish momentum is the positive one, the bearish momentum, the negative one, actually failed to do its job. And it's used up a lot of its ammo. It doesn't have as much dry gunpowder left for another round of the same sort of price action. Okay, so what you're looking at there is an increase in potential for movements towards the top side based on the fact that the strength and of the downside movement has waned an awful lot, or indeed